Let's look at measuring liquidity using the current ratio. This is one of our main financial ratios in the finance topic that we can use to do comparative ratio analysis and evaluate or assess the finances of a business to make a judgment on their financial performance. So we use the current ratio to assess the objective of liquidity. Well, firstly, what is liquidity? It is the business's ability to repay their short-term debts. That is those that need to be repaid in less than 12 months or their current liabilities. The formula is, for the current ratio, current assets over current liabilities. Let's take a look at an example here with some of the balance sheet information for the Flying Dutchman in 2023. We have got $20,000 in current assets as cash, $50,000 as inventory or stock, and $30,000 we're waiting to collect as accounts receivable. So we've got $100,000 here. Then over in current liabilities, we've got $25,000 as an overdraft from the bank, and we are owing $25,000 in accounts payable to our suppliers. So we have got $50,000 in current liabilities. So if we chuck it into the formula, CA over CL is 100,000 over 50,000, which as a ratio gives us 2 to 1 or 200%. So this is fantastic. 2 to 1 is our ideal ratio. What this means is the business can use this $100,000 to pay off the $50,000 in current liabilities, and they'll still have $50,000 left over in working capital. So they have sufficient current assets to cover their current liabilities. They don't have enough in just cash alone to pay the overdraft and the accounts payable, but they can sell the stock, turn that into cash. They can collect the accounts receivable, and that will become cash as well. And then they can repay those overdraft and accounts payable. So this means that for every $1 in current liabilities, the business has $2 in current assets. So our judgment would be that this business has sufficient liquidity. They will be able to repay their short-term debts in a comfortable position. Next example, we've got Globex Corp in 2023, some balance sheet information for them. We've got 30,000 in current assets, and we've got 50,000 in current liabilities. You can already see that's not very good. There's too many current liabilities. CA over CL is 30,000 over 50,000, which is 0.6 to 1 as a ratio. So this business doesn't have the cash, doesn't have the inventory or accounts receivable required to pay off that $50,000. So that means they might have to pay some late fees if they can't repay these debts on time. They might have to pay extra interest on that overdraft because they can't hurry up and pay it off. It also might hurt their relationship with their suppliers or the banks that they're borrowing money from. So this is going to be a problem if they don't have sufficient liquidity. We have also got some extra data here for this business. Looking at the industry average of other similar businesses is 2.2 to 1, and their previous year in 2022 was 1.8 to 1. So we can say compared to the industry average, they are worse than their competitors in the industry. So they're at a disadvantage. Their competitors have got more liquidity sitting around that they can take advantage of. It has also deteriorated or is worse than their historical performance or their historical average as well. So this business not good, insufficient liquidity, and it means they're unable to repay short-term debt commitments for Globex Corp. And last one, the Krusty Krab here in 2023. We have got heaps of cash, plenty of inventory and accounts receivable, totaling to $250,000 in current assets, and we've got $100,000 in current liabilities as an overdraft and accounts payable. So 250,000 over 100,000 is 2.5 to 1 or 250%. So that looks fantastic. They've got plenty of current assets to cover these current liabilities and pay off the $100,000. They'll have $150,000 left over in working capital. However, we can kind of see there's a problem that this is inefficient. What else could they be doing with all that extra cash and inventory that is sitting around? The stock or inventory could be perishing or going obsolete and they're having to pay to store it. They got extra cash just sitting around. They're waiting to collect these $50,000 in accounts receivable. What else could they be doing with that extra money? This indicates to us this is inefficient use of their assets. They could be more efficiently used for their purpose, which is to generate revenue. So even though they have sufficient liquidity, the business has excess current assets that could be used to generate more profit for the business. So we've looked at how we can use the ratio of the current ratio to measure liquidity. We've looked at using this to do comparisons and how to then form a detailed judgment on the business. Thank you.